Hello and welcome to Trust number 2. I don't know if you're having other trust lectures or this is currently forming the basis of what you're studying. Obviously, these talks are meant to supplement your own independent study. I assume that you're having other lessons. If that's not the case, let me know. But what I'm going to do really now is try and work sequentially through the book, through your study guide, which looks a bit like this. And if you can try and read before the next set of talks, I'm going to try and upload them weekly. I do have another job, so I'll do my best. But keep reading through. I would try and say week by week if you can. Do as much of the independent reading as you can. Do as much of the reading in the textbooks available as you can, and work through the exercises because they're good exercises in the study guide. And what I'm going to try and do is really have a look through it and try and supplement what you're reading and hopefully give you some context or some more ideas to think about as you go through and to try and explain some of the trickier concepts. So we're looking today at chapter 4 of your study guide, which is about the express trust relationship. One of the things that I'm slightly wary of when I'm reading the subject guide is that it does assume that you have some financial knowledge and some ideas of how investment works, especially at higher levels in the city. And so I apologise if this talk comes across as quite patronising or it deals with very, very basic things that you already know. But for this first video, and if you feel like you do know economics quite well, by all means skip the rest of this and move on to the second one. I want to go through some of the economic realities in the UK and in Europe that are informing the duties of trustees. Some of you may have done economics before. Most of you, I think, will have done some company law. If I think you have company law on your subjects list. And presumably some of you know some things about sort of companies and shares and stocks and supply and demand and all those sorts of basic economic concepts. But I am wary that for some of you, you may not have dealt with money beyond earning cash, using cash to live off, to buy food, shelter, basics, clothing, give money to your family. So you earn the money and then you spend it, you put it back into the economy, and you may save the money at a bank. And that's the very basic concept of money. But some of your understanding of this chapter relies on a slightly more advanced understanding of how the different ways to deal with money work. If you imagine that somebody, let's just say somebody just gives you a bank account of money, they sign it over into your name, you might think about what you could do with that money. Depending, if it's not that much money, or you really need your immediate needs met, so you don't have any food, or you need shelter, or you need to pay rent, what you're probably going to do with that money is spend it. You're going to have your bank account of money, let's say it's 1 million shillings, so you inherit it. And if you've got no other income, or it's not a massive amount of money, you're likely to be using that for your day-to-day living expenses. So the amount of money in your bank account goes down until it's gone. That's one way to think about money. And that's probably the thing that you're most familiar with. That's how you handle money. The other thing that you might be able to do with that money, depending on how much it is to purchase an asset with it. And by asset, what we mean is something that is a belonging or a right that has value. So if you buy clothes, it doesn't really have too much of a resale value. It might have a little bit of a resale value, but not like if you buy a car, that's a depreciating asset, but it's still an asset because you buy it and you've got many years of use out of it. And if the time came where you really needed the money again, you could sell the car for less than you bought it, but you could sell the car. And some assets are an appreciating asset. So the value will go up or the value will probably stay the same. So like land, you might buy land. So if you inherit this money and you buy a house with it, especially in the UK, land is very valuable. And for most people, the house, if they own a house, that's by far the most valuable thing that they have, because it's a small island and there's a lot of people on it. And so land is really in demand. So lots of people want to own their own plot of land and have their own house on it. And so normally when people buy a house, the value of that house keeps going up, and they can sell it for more than they bought it. So it's an appreciating asset, but it's still an asset and you can't do a whole lot with it while you have it. You can leverage a mortgage against the house and free up money that way, but there's not much. It's not very what we call liquid, and liquid is how quickly can you turn your asset into cash that you could just spend at the market. Most assets don't tend to be particularly liquid. Sometimes things like stock, or if you're selling something, your asset, part of your assets is also your stock and the value of your stock, and that's considered quite a liquid asset because especially if it's food, you're selling it on, and so you turn it into cash, and that cash is, or your profit is, what you can spend. So it's fairly liquid. Land, not very liquid. It takes a long time to sell land, and people keep it for a long time. Now, the third thing that you could do with the money that you've inherited, let's say, is you could invest it, and you can use that money to try and make more money. So one of the obvious ways to do this might be instead of buying a house with your money, you buy a shop, or you buy premises for a shop, and you use some of that money to buy stock for the shop, and then you sell it on at a profit. And you've invested that money, and you may have kept most of the value of that money because you've bought the land that you're operating the shop from, so you could always sell that later. So you have an asset, but you're also trying to make money off of the asset you've bought. And that, in a very basic nutshell, is investing. Now, in the UK, there's a lot of ways to invest money. There's a lot of ways to invest money in a lot of countries. In London and a lot of Western countries, there's a stock exchange, which you may know about, which is where you buy and sell shares. And a shares is the portion of a company that somebody owns. And normally you get a certificate that says, I own 1% or 2% or 3% of this company, or I own 4 shares or 5 shares in this company. And a lot of them are publicly listed companies, so they get traded. People buy them, and they buy them with the idea that they can sell them on at a profit because somebody will still pay more for them, because that person, the buyer, thinks that they can sell it on for more money later. And if you say to me, Jess, that sounds a lot like gambling, how can the world economy be based on effectively gambling? Yeah, it is, which is a little bit worrying. And there's massive markets built on that, and huge amounts of the world's economy are based on basically gambling, on somebody else be willing to pay more for the money, and you not being the person who's holding that asset when it's no longer able to be sold for more than you bought it for. But these shares work very, very fast. Like on the London Stock Exchange, we're talking sort of fractions of a second. It's done by algorithms on computers. It's all automatic. Companies have massive, massive algorithms that do things automatically for them. And millions and millions of shares are sold and bought in a day. And that's true on the Tokyo Stock Exchange and the Vancouver Stock Exchange and the New York Stock Exchange. And a lot of investments and investment portfolios rely on a certain amount of shares. They're relatively safe investments. So we talk in the subject guide about trustees having the duty to invest money. And you might want to just ask yourself why that is. Why does a trustee have a duty to invest money rather than just keep it safe, or invest whatever property, or try and make money out of whatever property that they have? And that's because you may be able to answer this yourself, but just holding on to money for a long period of time essentially decreases the value of that money, even if you don't spend it, because of inflation. So you're probably familiar with the concepts, but you know how in Kenya 1 shilling in Kenya is worth an awful lot more than 1 shilling in Uganda. It's because Uganda experienced a much higher place of inflation, which means you can buy less basic goods with the same amount of money. And inflation happens all over the world. It's a fairly normal part of any economy, and different countries experience inflation at different rates. But inflation almost always happens, apart from in Japan, where they have deflation, and I don't really understand that. Don't write that down. But for most countries, you do have inflation. And so if you imagine, let's say a parent dies and they leave young children behind who won't be able to inherit their property until they're 18, and so it's held by a trustee. So let's say the parents' bank account, the children have enough money to live on, perhaps there's quite a wealthy family, and some of that money is held back under the parents' wills, so that it can be given, let's say, to their child to buy their first house. The trustees, if the children are young, if they're 1 or 2 or 3 years old, the trustees will be holding onto that money for quite a long time. And in that time, the money in the bank account will have probably decreased in value. If you're holding onto money for a long time, you're holding onto a lot of money, it's expected that somebody who's a reasonably prudent investor, if they're treating the money as their own, will have done something with it. They will have invested it into stocks or shares or land or bonds or gilts. There's all sorts of investments you can make. And I'm not going to go through all of the different types of investment. I'm not really a financial planner. That's not my job. But there's a lot of investments that available to people, and on a lot of different levels. You can invest small amounts of money. Often you might put it in a high interest bank account, and so the bank pays you a certain amount of interest, and that's because banks like having your money, because banks take the money and they invest the money that's held in bank accounts, and then they make profit off of those investments. That's why banks pay you interest. Everyone's involved in this. So it may be that the trustees want to make a very safe investment and they just put it in a high interest savings account. It may be that they want to try and make more money off of the money that they're holding. And depending on what's in the trust, how much is in the trust, and what kind of trust it is, if it's a trust of land or a house that no one's living in and they don't expect anyone to live in it for 20 years, then a prudent trustee, acting as they would if it was their own property, is probably going to think, well, I need to rent that place out, because the rental market is quite strong in the UK, and so it's right to try and rent it out. You can make money from that. But if it's a trust of a house for a child that has nowhere else to live, well, you're probably not going to be renting that out. The trustees are going to say, or going to give the child the right to live in that house, because the child has nowhere else to live otherwise. So what's reasonable for a trustee to be investing in and what they do with it is often a value judgment, but the beneficiaries have a right for the trustees to act in a reasonably prudent manner. I think they call it the standard of prudence, and you'll probably come across that in your reading. So there's a lot of options as to how trustees can invest money. So when we talk, there's a little bit in the book, and it seems to be quite keen on the idea of things like ethical investment. So certain investments are safer than other kinds of investments. And this is the important point. The more money you're likely to make off of the investments, the riskier it is, or the more likely that you're going to lose all of your money. So the company that you give the money to is going to go bust instead of making a profit, or the land that you buy is possibly not going to be able to be rented out. And that's because of the law of supply and demand, which is a basic economic concept. the lower the returns, the safer the investment is. If you had an option where you could invest a lot of money into something that's very, very safe and also makes you loads and loads of money, everyone would do it. And so you'd have a real difficult time trying to invest in it, and that's really not really how the market works. Because then everybody would do it, and companies springing up would spring up all over the place, and then it would become risky because the market was oversaturated. So it's all probably going to balance out. So just remember, it's going to make less money if it's a safe investment, but that initial money that you put in, which you call the capital, is probably going to be safe, and you're probably not going to lose that, and you might make a bit of profit on it. You might, in a risky investment, you might put the money in, but you're quite likely to lose it. But if you don't lose it, you're likely to make quite a lot of money off of it. And so for trustees, the question is, where do they fall on that balance? Do they want to make a little bit of profit, but maybe not enough to keep pace with inflation? Maybe not enough to pay the beneficiaries, let's say, an income, if that's what the trust is set up to do? Or do they put it into a risky investment, but they might lose all of the beneficiaries' money? And then they'd be in trouble for that. So things like the stock exchange, that's often, so stocks, shares, some types of company, they're probably, big established companies, they're probably medium investments. They're likely to make you quite a bit of profit. They're a little bit risky. Safer things maybe like land. They cost a lot of money to invest in, but nobody's producing any more land. If you've got land in a popular area, somebody's probably always going to want to buy that off you. So it's fairly non-liquid, but you're unlikely to ultimately lose all of the money that you've put into it. So that's a safe investment. But it might be difficult to make money off of, or you might not be able to liquidate it, so turn it back into cash if a beneficiary needs it to be turned back into cash. And then you've got riskier investments, which trustees probably shouldn't really be doing. If you think about a risky investment, startup companies, if you've ever heard that term, a startup company is one that comes up with a brand new idea and often gets quite a lot of money invested into it, on the basis that if the idea takes off and it becomes really, really popular, the people who invest a lot of money into it are going to make a lot of money. They're going to double or triple or quadruple the amount of money that they've put into it. But a lot of startups fail. And so people invest a lot of money and then they lose a lot of money when the company goes under. Depending on what kind of companies you've heard of, Uber is a startup that succeeded. That's a taxi company, so you call the taxi from your phone and the drivers work for themselves, so the drivers make their own profit. And unlike traditional taxi companies, the drivers can set their own hours, and so it's cheaper for the customer. In theory, the driver gets paid better, although possibly not. And that's been such a popular idea, and it's spread all over the world, that the people who've invested in Uber are going to double or triple or quadruple and make massive amounts of money from their investment. But for every startup that succeeds, there's a lot that fail. And that's a risky investment. So hopefully I've given you a little bit of a sort of whirlwind economic background. If you have any questions, do let me know. Otherwise, we'll move on to the next video.